and welcome to the trade size and trade styles presentation. Here is what we will be learning in this video. First and foremost, why stake size is important, the position management. Second, types of trading styles, swing trading, scalping, and so on and so forth. Third, money management, risk reward. Fourth, how volatility affects trades. And last but not least, contrary to what many might believe, volatility is good. One of the crucial aspects in trading is indeed the ability to apply the correct position management to your trades, but also know what type of trader you are. Trading size is critical when you're trying to understand how you will make money and also how much money you're risking in the markets. In a lot of respects, the amount you deposit in your account dictates how much you can stake per trade, but you consider how you use your available trade size and when it is right to use it. Money management will also be key when you are trading and are deciding how much to stake per trade. Often, it will mark the difference between a successful trader and a loser. To better explain this, we will take a look at the three main ways of trading the markets and the size you stake, which can be affected by the trade style you choose. Not all styles are the same, and you will need to choose what fits best. Currently, for example, the markets are experiencing extreme volatility. This is caused by dovish or hawkish statements by the policymakers regarding inflation and interest rates or country-specific developments. This can mean you make money a lot quicker than in previous market conditions, but also means you can lose a lot more. Are you prepared? To become prepared, the most important question you need to ask yourself when you start to trade is how much you want to stake. Remember, you can always increase your stakes anytime you like, provided you still have money to do so, which takes us back to the basic principle of placing your stakes according to your money management. Many successful traders manage to make money for a certain period of time, only to realize that it takes just a few mistakes without the proper money management, and they are out of the market as they run out of money. If you place too big a stake at one go, then on a bad turnout, you will be left with no fuel for the next available opportunity. Remember, the markets are here today and will be here tomorrow. So depending on your broker, you trade in £1 or €1 a point, or you trade in lots. So one lot equals X amount of pounds, or the equivalent currency. A typical lot in FX will mean that you are buying 100,000 units of the quote currency, that is the second currency. As an example, a lot in the euro-dollar would mean that you would be buying or selling $100,000, not euros. There are also smaller denominations, such as mini lots equal to 10,000 units, and micro lots equal to 1,000 units, which are used by smaller retail traders. A lot size, then, would determine the value of the pip, the smallest increment when trading FX. If we keep it simple, say the minimum you can trade is £1 a point. So, for every pip movement in your favor, you make £1, or every movement against you, you lose £1. Certain trades may need different stakes. For example, if you hear very strong fundamental news, it may be an idea to use more of an aggressive stake than normal, as you are more certain what the markets will do. So, if you trade £1 a point normally, but here this has been a surprise interest rate hike, you can trade bigger size knowing what the markets may do. Again, this will be solely down to your own risk profile and management. Comparison kills. It doesn't matter what other traders stake. What matters is what fits your strategy. Let's see what this means in essence. If you start at the minimum stake, you can always move up. It is important to remember that trading is not fixed odds. So you can lose much more than you stake and also lose more money than you actually deposit in your trading account. This is especially true as you will employ leverage in order to maximize your exposure. It is also worth noting how quickly you can make money, but also how quickly you can lose money. In fact, markets are subject to the law of gravity, so to speak. They tend to fall faster than they rise, as human behavior dictates that people would rush to the exit when things turn nasty, but only enter slowly and certainly one by one when markets rise. The chart in the example shows how a starting stake can make you profitable. On this £1 trade, depending on how long you hold your trade for, you can potentially make 61, 112 or lose £27. You can see the entry point marked in green frame to your left. Let's stick a little bit more to the previous example. Money management is the key to making consistent money, as we said. In this specific trade, we have set a stop on previous support at 9708.16. This is 27 pips, to put it simply. At £1 a point, we know this is what we are risking and can lose. We chose this point as it has proven in the past that it was a point where buyers came in. If they do not do that next time, then we can safely exit. This is a simplistic approach of placing your stops, but we explain more about it in our other presentation. However, it is a starting point. On the upside, we want to sell our long or buy trade at 9795.56. This is a 61 pip profit and therefore makes us £61. Versus our £27 risk, this is a risk-reward ratio, to put it simply, of around 2 to 1. We're looking to make double what we risk, and this sounds roundabout right. Note that it has previously taken 8 15-minute candles to bounce between these levels. That means 2 hours. The same will stand with the upper trade idea. We want to exit at 9847.10. This is £112 profit versus the £27 risked, giving us 4 times the profit versus what we risked. Again, time is important here. It has taken previously 4 15-minute candles to bounce between these levels. This is just 1 hour. This is a great example of how to trade volatility, having fixed points in the market when you know you're wrong and exit, but also having defined areas in the future where in a relatively short period of time you can make your profit. This can only be used with your technical calls and sound use of stops. Now that we have defined how important it is to manage your trade stakes, we should look into the trade styles. When it comes to trading the markets, you should consider how other people trade. People will look for certain conditions within the markets and trade differently. Also, people who hold trades for different amounts of time will also adopt different trade styles. In broad strokes, there are 4 different trading styles one can adopt. We're talking about the swing trading, the momentum trading, order trading, and scalping. All these trading styles require your money management skills and also the consideration of time. You can scalp with the same risk as you can swing trading, for example, but there is no guaranteed way of making money, so your trading style is key. When you know why you lost or made money based on your specific style and risk management, you can repeat the process, or avoiding doing the same mistakes following the same process. It would be nonsense, as Einstein said, to be following the same process and expecting different results, wouldn't it? So let's take a look at our first trade style, swing trading. Swing trading is more of a longer-term trade. This means, in trading terms, it can be hours or even days before you see the benefits of your trade entry. With swing trading, it is just that. You're looking for the buying momentum at the top of a market to run out and sell. You're ultimately looking to sell high and buy your trade back lower. Take our example on Australian dollar against the American dollar. We have marked the 3 tops that the market dictated in red frames. You can see that there is excessive volatility in this specific period, which would allow a swing trader to take advantage of being slightly more long-term. A swing trader would try to identify that first topping price and short the market. He or she would then expect to close it significantly lower, thus compensating for the risk taken, as more time into a trade would typically mean more risk taken. This means your risk reward may have to be at 3 to 1 or even 5 to 1 and above. You are trying to take enough risk to get the top or bottom of a market and then to hold on to get your reward. The risk reward reflects the time you will want to be held in a trade. You can see marked in the green frame below that we would be buying back our short position at that swing low. This is an example, of course, of what a swing trader would expect to do, not that picking and forecasting the highs and lows is an easy task to do. That is especially true when it comes to absolute tops and bottoms. Last but not least, this is a style where you would expect to increase your stake in an effort to capitalize on your bigger risk taken. Remember that risk and return always go hand in hand. The next trading style you could decide to adopt is the momentum trading. This is about spotting a trend and then trying to get on the back of that continuation. Markets will exhibit a trend up or down. Once you identify this, you're looking for an area within the market where it consolidates or pauses and then the original direction continues. It is a strategy where you would be buying the strength and selling weakness. The American dollar against the Swiss franc chart shows an example of an uptrend. A momentum trader would try to catch exactly that, the momentum of the start of the uptrend. You can see that marked with a green frame at the price corresponding at 0.98730. That is, $1 buys roughly 0.98 Swiss francs, so the Swiss franc is seen as the stronger currency. Your risk reward should be fairly tight on this, as you do not want to be wrong. The trend should continue fairly quickly with momentum trading, and if it does not, then the trend usually will reverse. We have also marked in blue frame the short consolidation area before the big green candle takes place. This pause to catch a breath is frequent in markets, and depending on the technical formation, it will also show a projected profit target. In this case, the American dollar moved up all the way to around 0.99605 and gave a topping signal marked in red frame. This was a healthy movement that caused the US dollar to appreciate against the Swissy. Now $1 buys a little more of Swiss francs than before. Note that the risk-reward ratio should be 2-to-1 or 3-to-1, not more aggressive than this, as you might get easily caught in the wrong direction and lose more than you might have planned. A fair portion of traders might also prefer what we call order trading. Order trading is finding key levels of support and resistance that have worked in the past, using them in the past to predict the future. This may mean going back to the monthly, weekly, or daily charts to find absolute highs and lows. What does that remind you? Correct, a multiple time frame perspective. These are the levels in which you would put your orders to buy and sell. High levels to sell, low levels to buy. As these are the extremes of the markets, you should only really have a very tight stops, as these levels are either where the market is or turn, or if they are back to new highs or lows, we are entering the unknown. Note that a 1-to-1 or 2-to-1 risk-reward ratio and the lower stake is what we would use in a prudent way in this trading style. Last but not least, many traders choose to be scalpers. To put it bluntly, scalping is to take a lot of very small trades in a short space of time. A trend can be used for confirmation, it can also be used against it for profit taking. Look at the graphs in our slide. We have plotted a 5-minute trend and a 1-minute trend. Most people would categorize that as noise. It is too short of a time frame to seriously take into consideration. However, the adrenaline that comes to quickly open and close positions for only a handful of pips makes many traders wanting to capitalize on this. The so-called expert advisors also help toward this. By expert advisors, we mean that the machine will be deciding your entry and exit points through an algorithm that you yourself have written in the system. Essentially, the nature of a scalp is that you want to make the most of any extended 5-minute or 1-minute candle. You're looking for very small profit and a frequent basis, but this means that you can't take any real risk. Small profits should be matched by small risk. Risk reward will be 1-to-1 or 2-to-1. As scalping requires as low a latency, that is delay, as possible, and the perfect execution, you would find that most traders would use, either wholly or partially, an algorithm to help them profit from these opportunities. However, please remember that no machine can do the work of an extraordinary person, and that at the end, even machines will make mistakes simply because the parameters that you, as human, have set have now changed. Now let's take a look at a very important aspect of markets, one that often traders tend to overlook, that of volatility. To deal with volatility is to deal with rapid price movement over short periods of time. This is caused by new information, global uncertainties, and also the times that the most traders are in the markets. For example, when London closing and New York opening times overlap. Volatility in currency pairs outlines that pair's certain characteristics. That goes back to picking currency pairs to trade in busy times, as although this is a 24-hour market, not all times during the day would exhibit the same volatility, i.e. many traders actively involved in the market. Focal points for trading activity is most often than not the Asian, European and US sessions overlapping, so when almost all traders would be involved in some sort of trading activity, thus increasing the volatility overall. However, that statistical measure of standard deviation of price movements, a name to denote and underlines volatility, that is, would be different for all sorts of currency pairs, and so entry and exit points should have a different basis of calculation. For example, how to place your stops based on that volatility and the average movement of a currency pair within a day or a certain time frame and time of the day. To cope with volatility, you have to make sure your stake size matches your account balance in terms of risk, and also be aware of how far your market can move in a short space of time. You can effectively make more with less money. In the example provided, we have taken the cable, that is the sterling against the US dollar, and marked some very big green candles. An excessive volatility has taken place 3 times within that time frame, and you can realize a handsome profit if you come prepared, with the correct style and without risking too much. We have seen how the different trading styles would form your decisions, but also different risk-reward ratios. In conclusion, you have to remember that you can only trade with money you have. The more trade size you use, the more risk you take. Ultimately, if you lose on bigger size, your account will go down quicker. There are many ways to trade, but you will soon find out which suits your risk appetite. Quicker scalps require smaller size and risk and time in the markets, whereas swing trades take more risk, bigger size and significantly more time in the markets to yield the result. Find the balance of trade size and style that suits you.